Joining me now at Post 9 to discuss, Kevin Gordon of Charles Schwab. Welcome back.
Hey, Scott. Good to see you.
So, all right, so we're back above 38,000.
Yes.
Well, not back above. We're above 38,000 for the first time ever. We fluctuated a little bit today, but we're still sitting there. For somebody who has been cautious for a while, I think that's fair to say. Where are you now?
Well, a lot of it started to turn, when we got to the October period where you had started to see a pretty healthy washout in sentiment. Breadth wasn't as good, but the sentiment backdrop was enough, and then you had the rolling over in rates, which sort of started to propel and helped lift, basically everything.
So have you done a 180 then on your market?
Well, it's never that we were completely outright bearish last year. It was more of a cautious optimism on the part of the rest of the market, which you and I have talked about a lot. The rest of the market not really following up to what had been this leadership status from things like the Magnificent Seven. That obviously changed to a significant degree in November, December, and then we've kind of entered back into this chop phase in the beginning of January. Because I still think, even though you're getting to all-time highs on some of the indexes like the S&P, you still have some of these strange divergences where, I think it's still the first time where you've gotten to a new all-time high for the S&P, but for something like the Russell 2000 that's still in a bear market, you've never really had that before. The closest instance you had was in '98 when the Russell 2000 was still down, I think, around 19%. S&P made a new high. Wasn't Armageddon for small caps because they ended up catching up. Took a little bit after that, but they ended up catching up. So our thinking has never been, don't just villainize the small group of stocks that are leading the market, which is no longer the case. Things have broadened out from here. You've gone through a little bit of a corrective phase under the surface of the market, which is kind of the way you want it to happen. But it's not this, I think, outright bullish, outright bearish way to view things. We look at it at a much more nuanced level than that.
Sure, but if I just ask you plain and simple, is the stock market going to do well this year? What's your answer?
I think the runway is improved if you continue to see what you and I have talked about a lot, which is this rolling weakness under the surface of the economy transform and sort of transfer to different sectors at different times. Because you look at certain sectors like manufacturing, particularly in the sentiment world, where a lot of that data still looks weak, still looks recessionary. If you were going to take something like the Empire survey last week, which got a lot of attention, doesn't portend a very strong reading for ISM manufacturing, and at the same time you're starting to see more cracks underneath the surface of the labor market. But if that doesn't morph into this widespread weakness at the services level or at the overall labor level, then you don't go into a full-blown recession and you sort of continue to roll on with the unique nature of this cycle. All of that being said, that probably paints a better scenario for equities. And I think it's a much better way to think about it where you kind of normalize. You go into an environment where you no longer have these huge divergences between large caps versus small caps or the Mag 7 versus the rest of the market. That was very much the story last year, as we all know. But a character of a market that was November, December, where you did really start to see a broadening out. That's something that we would look for this year. May not be as great at the headline level, but under the surface it would be a lot better.
You think that was anything more than just run for the money heading to the end of the year?
I mean, I think there was definitely a lot of pressure that had built up and sort of pushed money and that was itching to look for other parts of the market that hadn't done well. But at the same time, the breadth picture for even something like small caps has improved dramatically. Just look at the percentage of companies within even the Russell that are above their 200-day moving average. You've made a series of higher highs and higher lows in that index. So even though you've been in this chop phase since 2022, where you've gone up 20%, down 18%, up 15, down 10, for a considerable period of time, throughout that entire period, it isn't that breadth is weakened, it's actually started to strengthen.
So then I'm not suggesting you should be anything in your view of the market, but why aren't you more bullish if you're here pointing out this broadening that you think is believable, especially under the surface in something like small caps? Because, money's gone back into the mega caps, so if you believe in the mega caps and now you believe in the small caps, aren't you painting a more bullish scenario for your own outlook?
And it's not a binary trade. I think one of the things, and I talked about this last time I was on with Mike, one of the things I think we get caught up in a lot is it going to be, one group that has to do well at the expense of the other? I don't think that's the case. I think that both can do well, and that's why I talk about this more normalized environment where you can get to a scenario where if the economy stops sending these sort of late cycle, signals, whether it's from the leading indicators or whether it's from the manufacturing and the housing side, which thankfully some housing data to be turning and maybe not entering their own expansion, but at least firming up a little bit, that ends up being a better scenario for the overall market itself. But, headlined index gains that you saw last year because of a couple of names that happen to, constitute a large portion of the index, maybe that's not the case moving forward, but I'd much rather look for something that's a lot healthier where you have participation under the surface improving at a much faster degree.